Today we're going to discuss a word that everyone is talking about these days. Recession. Simply put, a recession is a cycle that happens when economic activity generally declines. In this situation, there's a substantial drop in people's spending, and people are less likely to spend on non-essential goods and services. Recession could be caused by many different events, such as a financial crisis, similar to what we had in 2008 and 2009, or bursting of an economic bubble, like dot-com bubble that happened between 2000 and 2002, or a large-scale natural disaster like a pandemic, exactly similar to the COVID pandemic that hit the globe in early 2020, or even an inflation or a deflation can also lead to a recession. Stay with Dr. Egghead, and let's talk about recession, its definition, its causes, its impacts on people and markets, and even how governments respond to it. From a financial point of view, a recession is defined as a significant decline in economic activity spread across the market, lasting more than a few months, normally visible in real gross domestic product, GDP, real income, employment, production, and wholesale and retail sales. When gross national income, GNI, which is the total domestic and foreign output claimed by residents of a country, declines for 2 consecutive quarters or 6 months, we say we are in a recession. In a recession, gross national income, GNI, can decline by 1.5%. Non-agricultural employment can drop by 15%. And unemployment rate can rise to 6%. In the early stages of a recession, due to lack of demand in the markets, production of goods and services fall, and as a result, companies face a lot of struggles such as paying back debts and loans, paying the wages and even supplying raw materials, and eventually they get forced to freeze new hirings and salary raises, deploy huge layoff policies and eliminate less important job positions. A lot of businesses either go bankrupt or go out of business permanently, and people gradually lose their jobs. This job loss situation fuels a further drop in goods and service demand and makes this cycle last longer. During a recession, lenders tighten requirements for mortgages, auto loans, and other forms of finance as more people find themselves unable to make their payments. Unlike normal economic circumstances, you need a higher credit score or a larger down payment to qualify for a loan. A recession could also affect the stock market and the real estate market as well. 10 recessions since 1948 have been preceded by a stock market downturn, with lead times ranging from 1 to 13 months. Additionally, the housing market typically declines before a recession. While recessions tend to end within months, real estate falls can drag on for years. Therefore, a sudden decline in the stock market or real estate market could be interpreted as an early sign of a coming recession. A recession can occur in a specific country, or it can happen in many countries simultaneously and form a global recession. According to the International Monetary Fund, IMF, if global annual real world gross domestic product, real world GDP, grows only 3% or less, it is called a global recession. By this measure, there have been at least 6 global recessions since 1970, with the worst one after World War II, both in terms of the number of nations affected and the decline in GDP, being the Great Recession of 2009 and the most recent and the second largest one being the COVID recession of 2020. At the time of creating this video, there was a prediction by financial institutions that the global economy may see another recession in 2023. This may happen due to the policy of raising interest rates in 2022 that central banks have deployed to curb inflation. Recessions usually last less than a year. If a recession lasts too long or for many years and is accompanied by severe unemployment rates, lower prices and incomes, and a lack of consumer confidence, it is called a depression. Although depression is not an officially recognized term, the worst recession in history that lasted for 10 years between 1929 and 1939 is called the Great Depression. There is also a very rare situation where a recession and inflation, which are normally in contrast with each other, both happen at the same time, which is called stagflation. This could occur due to big changes in commodity prices and economic policies occurring simultaneously. We hope Dr. Egghead could have explained recession as simple as possible for everyone to understand. Now that we know what exactly a recession is, it's not a bad idea to briefly explain how governments deal with a recession. If a recession occurs, governments come up with different solutions to take that under control. Increasing the money supply, reducing interest rates, increasing spending, reducing taxes, or even deploying all these policies together, are among the most common actions that governments take to counter a recession. By taking these steps, governments try to encourage people and the whole economy to spend more money in order to trigger a bigger money turnover that could potentially lead to a more dynamic economy. By the way, the next recession could be around the corner. Do you think you are ready for it? How do you think we could prepare for an upcoming recession? Leave us your comments, and if you like this video, don't forget to hit the like button and subscribe to the channel. See you soon.